Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 5 of 14, The Enterprising Investor's Edge, and why you're probably not one, from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig.
It is really good to be back. And today we're walking straight into a minefield, honestly. This chapter is probably the most seductive part of the entire book.
Graham says there are two types of investors. Most people pick the wrong one, and that mistake costs them everything.
Yeah, that's the cliffhanger right there. The distinction between the defensive investor and the enterprising investor. And I think before we even define them, we really have to talk about the ego trap that's just built into those labels.
Oh, absolutely. I mean, just look at the words themselves. Defensive sounds weak. It sounds like you are curled up in a little ball while life just happens to you.
Right, sounds cowardly almost.
Exactly. But enterprising sounds heroic. It sounds like Captain Kirk or something. It implies you are smart and ambitious and you're out there making things happen. If you ask a room full of people which one they are, nobody is going to raise their hand for defensive.
Nobody. And Graham, he totally knows this. He knows that human nature drives us to want to be the hero of our own financial movie.
Yeah.
We all want to believe we have what it takes to beat the market. But he flips the script on these definitions in a way that is just incredibly humbling.
Right, because we usually assume that the difference between a passive investor and an active investor is just about risk tolerance. Like, I'm young, I want to get rich, so I'll be enterprising and take massive risks. Or I'm retired, so I'll be defensive and just buy safe bonds.
Yeah, that is the standard Wall Street categorization, and Graham completely rejects it. He does not divide investors by their risk tolerance, and he certainly doesn't divide them by their intelligence. He divides them by their willingness to work.
And when we say work, we are not talking about checking your brokerage app on your phone while you're waiting in line for your latte.
No, definitely not. We are talking about forensic accounting. We are talking about intellectual manual labor. The defensive investor is defined by a desire for freedom from effort. They want a decent result without having to treat their portfolio like a second full-time job.
But the enterprising investor...
Graham is very specific here. This is not someone who takes more risk. In fact, he argues the true enterprising investor takes significantly less risk than the market average.
Which is a huge paradox for most people listening. How do you beat the market by taking less risk? It goes against everything we are taught about finance.
You do it by doing the work that other people are literally too lazy to do. By finding bargains that are so mathematically obvious that the risk is virtually eliminated. But that only happens if and only if you're willing to dig through thousands of pages of boring documents to find those rare opportunities.
So the hook for this whole deep dive is really a challenge to you, the listener. Graham is asking, are you willing to treat investing as a full-time business? Not a hobby, not a side hustle, an actual grueling business.
It's a binary choice. You are either passive or you are active. There is no middle ground in Graham's world. And the really dangerous part of the trap we mentioned earlier is that most people fall into this middle category of being semi-enterprising.
The semi-enterprising investor, that honestly sounds like most of my friends.
It is most of the market. It's the person who reads the headlines, watches a little financial news, follows a few stock pickers on social media, and buys shares in a company just because they like the product. They feel like they are doing research. They feel enterprising.
But Graham would say they are basically just playing dress up.
He would say they are sheep waiting to be sheared. Because they are doing just enough work to give themselves false confidence, but nowhere near enough work to actually have an edge. They are playing a professional sport with amateur conditioning.
And his warning there is pretty stark. The defensive investor, the one who just buys the index fund and goes to the beach, will almost always outperform the semi-enterprising investor who tries to be smart but fails to do the heavy lifting.
Always. Because the semi-enterprising investor is taking on the frictional costs of trading and the psychological burden of market timing without the mathematical advantage required to win.
So today, our mission is to deep dive into what that heavy lifting actually looks like. Because Graham does have a strategy for the true enterprising investor. And it isn't buy what you know. It is a cold, hard mathematical formula called the net-net.
The net-net, the holy grail of deep value investing. It is a strategy so rigorous and honestly so ugly that almost nobody uses it today because it's just too much trouble.
Before we get to the actual math of the net though, and I do want us to break that balance sheet down line by single line, we really need to talk about the negative approach. Because Graham starts this lesson not by telling you what to buy, but by aggressively telling you what to run away from.
Right. If you are going to be an enterprising investor, your absolute first job is to stop bleeding money on unforced errors. And Graham has a very specific hate list.
Number one on that hate list is what he calls new issues, or as we call them today, IPOs. Initial public offerings.
He absolutely loathes them. He despises them. And this is fascinating because IPOs are always marketed to the public as the ultimate opportunity. Get in on the ground floor, buy the next Amazon before it blows up.
Why is he so allergic to them? Is it just because IPOs tend to be really volatile in the first few months?
It is much deeper than volatility.
Yeah.
It is fundamentally about informational asymmetry and market timing. Think about the basic mechanics of an IPO. When does a company usually decide to go public?
Usually when the market is really hot, you don't see a lot of IPOs launching in the middle of a massive recession or a market crash.
Precisely. They go public in roaring bull markets. They go public when the quote-unquote window is open. That means the seller, the company founders, and their investment bankers are choosing the exact specific moment in time to sell shares to you. They're selling when the history books say prices are at their absolute peak.
So the seller inherently has the advantage. They control the timing of the transaction.
And they completely control the information. The insiders selling the stock have spent years building the company. They know exactly where every single skeleton is buried. You, the buyer, have a glossy prospectus written by a team of lawyers to make everything look perfect.
And Graham's rule here is simple. The enterprising investor does not buy when the seller has the advantage.
It is like buying a used car. If you buy a car from a slick dealer who polished it up, put balloons on it, and listed it during a massive holiday sale, you are paying full retail. Graham wants to buy the car from the guy who is desperate to sell it to pay his rent tomorrow.
That is the perfect analogy. Graham wants to be the buyer of last resort. In an IPO, you are volunteering to be the buyer of first resort. You are the dumb money providing exit liquidity to the wealthy insiders.
Exactly. And he also heavily flags junk bonds and foreign bonds of dubious quality on this hate list.
It's that same principle of avoiding the flashy trap, right? Avoid yield chasing. If a sketchy corporate bond is paying 12% when the safe bank rate is 4%, there is a massive reason for that gap.
Right. The defensive investor buys a certified pre-owned Toyota, high-grade bonds, broad index funds, safe, reliable, boring. The enterprising investor might be willing to buy a mechanic special. They might buy a distressed bond or a severely beat-up stock. But, and this is the vital key here, they only do it if they're actually a mechanic.
If you buy the mechanic special and you don't actually know how to rebuild a transmission, you didn't buy a bargain, you just bought a rusting lawn ornament.
And you're going to lose your shirt.
Okay, so we avoid the traps. We completely ignore the IPOs, the junk bonds, the hot story stocks. Now let's talk about what the enterprising investor actually does buy. Let's get into the mechanics of the net because this is the absolute core concept of the chapter.
The net is Graham's ultimate attempt to turn investing into simple arithmetic. He wanted to find a foolproof way to buy $1 for 50 cents guaranteed.
Now, when we talk about valuation today in 2026, people are always talking about price-to-earnings ratios or price-to-sales or projecting future growth rates out 10 years. Does Graham use any of that?
For this specific net strategy, no. He ignores almost all of it. He looks almost exclusively at the balance sheet. He is searching for pure liquidation value.
So the fundamental question is, if this company completely died tomorrow, sold every single thing it owned, and paid off everyone it owed money to, what cash would be left over?
That is the exact question. And to find that answer, he uses an incredibly brutal and conservative formula. It starts with current assets.
Let's clearly define that for any non-accountants listening. What exactly counts as a current asset?
Current assets are things the company owns that can reasonably be turned into cash within one single year. So obviously actual cash sitting in the bank counts. Marketable securities like short-term treasury bills count. Accounts receivable, which is money customers currently owe you, usually counts, though Graham might discount it a little bit if he thinks some customers won't actually pay. And finally, inventory.
So the physical merchandise sitting in boxes in the warehouse.
Right, so Graham takes all of that, the highly liquid stuff. That forms your pile of positive assets. Now here is where he gets extremely aggressive. He then looks at the fixed assets. The giant factories, the acres of land, the heavy machinery, the shiny corporate headquarters building.
The actual physical stuff that allows the company to operate as a business.
And he values them at exactly zero.
Zero. Wait, hold on. Let's pause there. If I own a massive operational factory in Ohio, that building is worth something. The land underneath it is worth something. Why on earth does Graham treat it like it doesn't even exist?
Because he is intentionally simulating a worst-case disaster scenario. If you are a highly specialized manufacturer and you go completely bankrupt, who actually wants to buy your weird specific factory? Maybe nobody. Maybe it's completely empty and decays for 5 years. Maybe your custom machinery is so specific to your failed product that it is literally just worth its weight in scrap metal.
So he wants a margin of safety that is so incredibly wide that he just assumes the real estate and the equipment are worth absolutely nothing.
Yes, it is profoundly conservative. He is essentially saying, I am not willing to pay for the engine of the car. I am only willing to pay for the liquid gas sitting in the tank.
That is a great way to put it. Okay, so you take the current assets, the cash, the receivables, the inventory. Then what?
Then you subtract all liabilities.
Not just the short-term bills due next month.
Everything. Every single penny the company owes. The mortgage on the zero-valued factory, the bank loans, the outstanding corporate bonds, the long-term pension obligations. You strip every single liability away from the current assets.
So the strict mathematical formula is current assets minus total liabilities.
Correct. And that specific number equals the net current asset value, or NCAV for short.
And what is the actual trading strategy once you have that NCAV number?
You only buy the stock if the current market price of the shares is significantly less than that NCAV number. Ideally, Graham actually wanted to pay only 2/3 of the NCAV.
This honestly sounds broken. You are telling me I can find a publicly traded company where if I just buy all the outstanding shares, I am getting their cash and their inventory at a massive discount, and I'm getting the factories, the brand name, the patents, and the land totally for free.
Yes, that is the literal definition of a net stock.
I really like the wallet analogy to make this concrete for the listener because the corporate jargon can get a bit dry. Let's walk through that scenario.
Sure, it makes it very visual. Imagine I walk up to you on the street and offer to sell you my wallet, a really nice high-quality leather wallet. You open it up to inspect it and you count the actual money inside. There is a crisp $50 bill in there.
Okay, I physically see $50 in cash.
But tucked in one of the little credit card slots there is an IOU note, a debt. The owner of the wallet owes someone else $10.
So the net cash value inside the wallet is $40. 50 minus the $10 IOU.
Right. Now imagine I offer to sell you that entire package. The nice leather wallet, the brand name of the wallet, plus the $40 of net cash inside. And I offer to sell the whole thing to you for a total price of $30.
I hand you $30. I immediately take the $40 out of the wallet. I have made $10 of instant risk-free profit, and I still hold the leather wallet itself, which I can maybe sell on eBay for $5 or just keep and use.
That is exactly what a net is. The leather wallet represents the company's factories and their business operations. In a net trade, you aren't paying a single cent for the leather. You aren't even paying for the full cash value inside. You are literally buying money at a discount.
But why on earth would the stock market ever let that happen? Markets are supposed to be relatively efficient. Why would any rational human being sell a wallet with $40 in it for $30?
2 reasons: deep emotional fear and the logical assumption of future cash incineration.
Unpack that cash incineration idea.
Usually, any company that is trading as a net is in a truly terrible real-world situation. They are probably losing millions of dollars every single quarter. The management team might be totally incompetent. The industry they're in might be dying entirely. So the market looks at that $40 in the wallet and says, sure, it is $40 today. But this management team is a bunch of idiots. They're going to lose $10 this year, $10 next year, and $10 the year after. In 3 years, that wallet will be completely empty.
So the market price is actually pricing in the future destruction of that current cash.
Exactly. The market is pricing in a slow, painful funeral. But Graham's argument is based purely on simple arithmetic and large-scale statistics. He says, I don't need to know if this specific company will successfully turn its business around. But I know that if I buy a large, diverse basket of these, if I buy 30 different wallets for less than the cash inside, statistically, enough of them will either survive or get fully liquidated that I will make a huge overall return.
You don't need them to suddenly become good growing businesses. You just need them to not set the cash on fire before the market realizes the pricing mistake.
Or honestly, you actually need them to drop dead.
What do you mean drop dead? Like go bankrupt?
Yes. If the company liquidates, if they actually give up and shut down the business, you get the $40. The stock price violently goes up to meet the liquidation value of the assets. So a net-net investor often profits massively from bad news. A formal bankruptcy announcement can actually send the stock soaring because the trapped assets are finally being unlocked and returned to the shareholders.
That is such a bizarre psychological space to operate in. You are actively rooting for corporate liquidation.
You are the vulture. You are the financial gravedigger. It is not a glamorous, prestigious job to talk about at a cocktail party, but it pays incredibly well.
This brings us perfectly to the stories. We have to ground this in reality because right now, to a lot of people, it probably sounds like a theoretical magic trick. Let's look at the classic case study Graham provides from Chapter 15, which is the Burton-Dixie Corporation.
Yes, this is the absolute quintessential Graham trade. It perfectly illustrates everything we just talked about.
Set the scene for us. We are not in modern times.
No, it is 1964. The Beatles are topping the music charts, the world is changing, and Burton-Dixie is a profoundly boring, sleepy manufacturing company. They make mattresses, furniture padding, and cushions for outdoor deck chairs.
Thrilling, cutting-edge stuff.
Just incredibly dull. And the stock market absolutely hates it. Nobody in 1964 cares about mattress padding. So let's look at the actual numbers Graham saw when he analyzed them. The stock price was currently trading at 20.
Okay, the market price is 20 per share.
Graham pulls their physical balance sheet. He calculates the net current asset value, the liquid cash, and the mattress inventory minus all their corporate debts. That exact number is 30.
So the cash in the wallet is 30 and the market price is 20.
Yes. And their stated book value, which includes the value of their manufacturing factories, was actually 50.
So the market was actively discounting the pure liquid cash by 33% and giving the mattress factories away completely for free. The market was valuing the actual operating mattress business at roughly negative $10 per share.
Think about the extreme psychology of the person selling their shares at 20. They were implicitly saying, I hate this mattress company so deeply, I'm willing to pay you $10 just to take the operating business off my hands.
So what did the enterprising investor actually do?
They bought it. And here's the most important part of the whole story. They waited. This was not a quick swing trade or a day trade. They bought the shares in 1964. And for a long while, absolutely nothing happened. The stock probably just waffled around aimlessly. The company just kept making boring mattresses.
The crushing boredom is the true price you pay for the margin of safety.
Exactly. You sit there looking stupid. But then in August 1967, about 3.5 years later, something finally changed. The undeniable logic of the underlying assets finally caught up with the depressed stock price. There was a formal buyout offer for the company.
And what was the buyout offer price?
$53.75.
From 20 to 53.75, that is a 165% total gain.
Which works out to roughly a 47% annualized return in a boring, forgotten mattress company. And the crucial lesson here isn't that the investor somehow magically knew a buyout was coming. They didn't have illegal insider info. They didn't personally know the CEO.
They just trusted the math.
They knew that 20 is strictly less than 30. They bought a dollar bill for 66 cents and patiently waited 3 years for the broader market to finally realize it was a dollar bill.
Now I want to shift gears and talk about how they actually found this trade, because in 1964, you obviously didn't have a smartphone. You didn't have a web-based stock screener.
This really highlights the work aspect of Graham's enterprising definition. Graham and his employees, including famous future investors like Walter Schloss, they used something called the S&P Stock Guide.
Which was a massive physical object, right?
A thick, heavy, dusty paperback book that was mailed out every single month. It contained thousands of rows of tiny microscopic print. And the enterprising work was literally sitting at a wooden desk, running your index finger down the page line by agonizing line. Price here, assets here, nope. Next line, price here, assets here, nope. You would do that manually for hours and days on end.
That is the infamous stock guide grind.
It is pure, unadulterated manual labor. It is boring. It literally hurts your eyes. But that was the edge. The only reason Burton-Dixie was mispriced in the first place is that the fancy Wall Street analysts weren't looking at it because it was too small, and regular retail people weren't looking at it because they weren't willing to read a giant phone book of numbers.
The edge was entirely in the friction.
Exactly. The immense physical difficulty of finding the information actively created the profit opportunity.
Which brings us to the giant modern elephant in the room. You and I are sitting here in 2026.
Right. The game has totally changed.
I have a supercomputer in my pocket. I can subscribe to a cloud data service that runs a complex net screen on 50,000 global stocks in 3 milliseconds.
And massive quantitative hedge funds have AI models that read and parse obscure footnotes far better and faster than any human ever could.
So if a stock magically trades at 20 with 30 in net cash today, doesn't a high-frequency trading algorithm just slurp it up instantly? Is the classic Burton-Dixie trade just completely extinct?
This is the great ongoing debate of modern value investing. And the brutally honest answer is yes, the easy net is entirely extinct. You absolutely cannot open a basic Yahoo Finance screener and find a company in the S&P 500 trading below its cash value. Those simple inefficiencies have been arbitraged away permanently.
So where has the enterprising edge actually moved in 2026?
It has been forced to move into the uninvestable corners of the market. I like to call it the dark matter of the financial universe. Things that are so obscure or difficult that the algorithms just break down.
Give me specific examples. Where are the modern enterprising investors actually digging for treasure today?
There are three main hunting grounds left. First is microcaps and nanocaps. We are talking about publicly traded companies with total market caps of maybe $10 million or $15 million.
That is incredibly tiny. That is the size of a successful local car dealership chain or a few fast food franchises.
Exactly. Now think about the big players, BlackRock or Vanguard. They manage trillions of dollars. Can a Vanguard fund actively invest in a $10 million company?
No. If they tried to put even a tiny fraction of 1% of their money into it, they would accidentally buy the whole company 10 times over. They literally can't fit their capital through the front door.
Right. Institutional capital is structurally and legally banned from owning these tiny stocks. So the Wall Street algorithms largely ignore them because they can't deploy meaningful capital there anyway. That leaves the playing field completely open for the individual retail enterprising investor.
Okay, so the first rule is go extremely small. Where else?
International markets, specifically markets with very different corporate cultures than the US. Japan is the classic modern example for nets. For decades, Japanese companies have been incredibly culturally conservative. They naturally hoard cash, and they absolutely despise taking on corporate debt.
So you actually have these zombie industrial companies in Tokyo trading for less than the physical yen sitting in their corporate bank accounts.
Hundreds of them. It's a known phenomenon. But the catch is you have to be willing to deal with currency exchange, risk-intense language barriers, and a deeply entrenched management culture that frankly often does not care about maximizing the stock price for foreign shareholders.
And what is the third hunting ground?
Corporate spin-offs and broken IPOs.
Yeah.
When a massive conglomerate dumps a small, confusing division onto the market, or when a SPAC, a special purpose acquisition company, completely collapses after the initial hype dies down.
Oh, the massive SPAC bust from a few years ago. That has to be an absolute gold mine for this strategy, right?
It is the perfect modern version of Graham's new issue warning. The SPAC launches at $10. The promoters hype up a futuristic merger. It spikes to $20. Then reality sets in, the projections fail, and it violently crashes down to $2. Sometimes at $2, it is actually trading below the literal cash it still holds in trust. The retail hype cycle creates the wreckage that the disciplined value investor patiently picks through.
So the core mathematical strategy still works, but you essentially have to be a financial dumpster diver.
You have to be deeply willing to get your hands dirty. But we have to add a massive structural warning here. A massive map for the 2026 listener.
The liquidity trap.
Yes. This is exactly what separates the theoretical textbook from the bleeding reality of trading.
Yeah.
In a finance textbook, if you buy a stock at $3 and its intrinsic value is $5, you make a profit. In the real microcap world, it is rarely that simple.
Walk us through the painful mechanics of that trap, because people need to understand why this is so hard.
Okay, let's role play. You run your fancy screener, you find a tiny, obscure manufacturer in rural Ohio. Net cash is $5 a share. The stock is currently trading at $3. It is a mathematically perfect Graham net. You decide to be enterprising and buy $10,000 worth.
Sounds incredibly smart so far. I'm locking in my margin of safety.
But then you look closely at the trading volume. This tiny stock might only trade 200 individual shares in a whole day. The bid price, which is what other buyers are currently offering to pay, is $3. But the ask price, which is what the current owners are demanding to sell it to you, is $3.50.
That is a massive gap. That is a bid-ask spread of nearly 17%.
Right. So to actually get into the trade, you have to cross the spread and pay the ask. You pay $3.50. The second your order fills, you're immediately down 17% on paper versus the current bid price. You start in a deep hole.
And then, let's say 6 months later, I get tired of waiting and I want to sell my shares.
Who exactly do you sell to? There is nobody there. The daily volume is a ghost town. If you try to dump $10,000 worth of shares all at once, you will completely crush the bid price down to $2.50 or lower. You are totally trapped. It is the Hotel California of investing. You can check out anytime you like, but you can never leave, at least not without taking a massive, brutal haircut on your capital.
This is exactly what the academic backtests and the quantitative studies usually completely ignore, right?
Exactly. There's a fantastic review by Alpha Architect on this specific issue. They looked at all the famous net backtests that historically show these massive 30% annual returns. But when they rigorously adjusted the data for the real-world trading costs, the nasty bid-ask spreads the price impact of actually moving the illiquid stock. The excess returns almost entirely vanished.
So the true enterprising edge in 2026 isn't just about finding the mispriced stock on a spreadsheet. It is fundamentally about execution. It's about being disciplined enough to buy slowly in tiny chunks over weeks and patient enough to hold for years until a catalyst like a buyout actually happens.
It requires the patience of a saint and the sheer stubbornness of a mule, which is why most people fail at it.
And honestly, this brings us to a really uncomfortable historical fact about Benjamin Graham himself. We treat this book like it's absolute sacred scripture. But later in his life, Graham seemingly lost his faith in this entire enterprising concept for the individual retail investor.
This is the dark part of financial history that the diehard value purists absolutely hate to talk about. In 1976, very shortly before he died, Graham gave a famous, heavily documented interview, and he basically completely flipped his stance.
What did he actually say? Give us the quote.
He essentially said, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities."
Wow. The literal founding father of security analysis, the guy who wrote the textbook, said, don't bother with security analysis. That is staggering.
He admitted that the overall market has simply become far too efficient. He looked around at the rise of the massive institutions, the early deployment of computers, the absolute army of professional analysts poring over data, and he reasonably concluded that the return on effort for the solo individual was just gone. He essentially predicted the dominance of passive index funds years before they were truly popular.
So he actually recommended the defensive passive path for almost everyone at the end of his life.
Yes. He ultimately felt that trying to be enterprising was just a dangerous ego trip for most retail investors. It was a waste of their limited time.
This sets up a massive philosophical debate that I really want to pose directly to you, the listener, because we are left grappling with two totally conflicting realities here.
The central debate question is simply, is the enterprising investor completely extinct?
Side A is the Graham purist. They adamantly say no. The edge still strictly exists in deep labor. The computer algorithms are incredibly fast, but they are contextually dumb. An algorithm can't read a complex pending lawsuit and understand the nuance. An algorithm can't call up a disgruntled competitor and interview them. If you are willing to do the deep, tedious, forensic, investigative work, you can still consistently beat the machines, especially in the murky microcap space.
That is a classic argument for the small investor advantage. You are small and nimble, so you can hunt in the obscure places where the institutional giants physically cannot go.
But side B is the modern realist. They fiercely argue that it is completely over. The intonational asymmetry that Graham exploited in 1964 is dead and buried. There are thousands of brilliant, hungry hedge funds fighting viciously over even the tiniest scraps of data. If a stock looks mathematically cheap on your screen, it is almost certainly a complex fraud, a value trap, or a severe liquidity trap. Just buy the broad index fund and go enjoy your life.
And honestly speaking, both sides have incredibly strong, valid points. The listener really has to look in the mirror and decide, are you really the apex hunter willing to do the grueling S&P stock guide level work? Or are you just the prey playing dress up?
And that leads us to the hidden psychological toll of this strategy, because we really haven't talked enough about what it physically feels like to hold these specific types of stocks in your portfolio.
It feels absolutely terrible. That is honestly the only accurate way to describe it.
That is a great sales pitch for value investing.
I'm being serious. To be a true net investor, you have to be deeply willing to look like a complete idiot to everyone around you. Imagine your neighbor is buying NVIDIA or whatever the hottest tech stock is. They're constantly talking about artificial intelligence and the shiny future at neighborhood barbecues. And you are quietly buying a failing company that makes rubber gaskets for 1990s tractors, and it is currently being sued by the EPA.
And the stock inevitably goes down another 20% right after you buy it.
Almost always. You are buying what Warren Buffett later called cigar butts. They are soggy, they're gross, they have been stepped on in the street. But Graham says they have exactly one good free puff left in them, and you are getting that puff for a steep discount. But most normal human beings cannot handle the intense social shame and the daily volatility of owning a concentrated portfolio of disgusting cigar butts.
It takes a very specific, special kind of contrarian masochism. You have to actively enjoy being hated by the market.
It really does. You have to derive your internal pleasure strictly from the pure math, not from the external social proof of holding a popular stock.
All right, let's bring this all home. We always want to leave the listener with something incredibly concrete that they can actually do. We call this the Monday morning audit.
This is a direct challenge to everyone listening right now. I want you to open your brokerage account app on Monday morning. Look at your current portfolio. Specifically, look only at the individual single stocks you picked yourself.
Right. Not your Vanguard index funds or your 401k target dates. We are talking about the fun stuff you picked.
For every single one of those individual stocks, you must ask yourself Graham's 3 enterprising questions.
Question 1, did I personally read the full financial statements?
And you have to be brutally honest with yourself. Did you actually open and read the raw 10K filing? Did you read the boring legal footnotes at the very bottom? Or did you just read a summarized Motley Fool article or watch a YouTube video about the stock?
Question 2, can I mathematically calculate the liquidation value right now?
Do you clearly know the net current asset value of that company? Have you manually done the wallet math we talked about? If the company completely died tomorrow, do you know exactly what tangible assets you would get back?
And the most vital one, question 3. Did I buy this stock purely because it was mathematically quantitatively cheap? Or did I buy it because I simply liked the qualitative story?
This is the absolute killer for most people. I think electric vehicles are, the future is just a story. I really like the visionary CEO is just a story. The current assets minus all total liabilities equals $30 a share, and the market price is $20, is a hard, verifiable fact. The enterprising investor under Graham's strict definition only cares about the facts.
If your honest answers to those 3 audit questions are no, I didn't read the filings, no, I don't know the liquidation value, and yes, I just really like the story,
then you need to urgently pivot your mindset. You have to realize that you are not actually investing. You are speculating. You are gambling. And look, there is fundamentally nothing wrong with gambling if you consciously know you are doing it for entertainment. But you absolutely cannot confuse it with the rigorous, enterprising work that Benjamin Graham is describing in this chapter.
And if you do that audit and realize you just aren't willing to do that agonizing level of S&P stock guide work,
then Benjamin Graham enthusiastically grants you permission. He actively urges you to be a defensive investor. Sell the risky individual stock picks. Buy the broad, low-cost market index, accept the generous average market return, and go spend your time with your family.
And the beautiful irony of this whole lesson is that by gracefully settling for the average index return, you'll almost certainly beat 90% of the semi-enterprising people who are actively trying to be smart.
It is always infinitely better to be a highly successful passive tortoise than a dead, exhausted hare.
That is the perfect summary of the chapter. The enterprising path is technically open to you, but the toll gate to get on that specific road is incredibly expensive. It costs massive amounts of time, effort, and your own ego.
And if you aren't truly willing to pay that steep toll, do not get on that road.
That was lesson 5 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.